Welcome to the deep dive video update. This is a weekly video where I pick out some of the charts that maybe I used a little bit, but I'm not using right now, at least over the weekend. Or there are other charts and some longer term charts, both daily and weekly charts, that I use just for this particular video because we have to look deeper to see if we're getting any insight from these particular charts. And sometimes we don't, sometimes we do. So I'll go through the charts and we'll see if this gives you any additional insight. And this is being prepared from Monday, August 18th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. This is an informational chart where we look at a long-term range of the VIX. And you can see over here on the right-hand side, we're below this red line. That's a VIX reading of 20. Now, the VIX is on this chart, but I turn it invisible, and I put a 50-period exponential moving average over top of that, because when we're in a lower range and when we're going down, we tend to be more positive. If you see when we were in a higher range, this was during the great financial crisis. This was during the COVID crash and then the bear market that we had in 2022. And then we've dropped down to a lower range. Now, we have been going back up in 2024, and we had a pretty significant downward move in March and into April. But since that time, we've been starting to come back down and see a lower range for the long-term VIX, and that tends to be more positive. We also look on a shorter term basis. What is the momentum of the VIX? This comes and goes out of the daily video. We're kind of going sideways right now. I use a MACD to measure, are we going up or are we going down overall with the VIX? And you have to think of this in the opposite way. As the VIX is going up, stocks are going down. As the VIX is going down, stocks are going up. We might see that get a little decoupled from time to time, where we have an up day and the VIX goes up, or a down day and the VIX goes down. But that, in the bigger picture, that usually doesn't happen. So after we really spiked up here at the beginning of August, we had a really solid down day when the employment report came out that was weaker than expected. The VIX went back above 20. Well, we've been bouncing up and repairing as far as price since that time. And as price has been going up, the VIX has been going down. And so we're seeing a general downward movement with the momentum of the VIX. Then even shorter term, I use an RSI 9 to see, okay, is the VIX moving too fast on a day in and day out basis? Right now, it's not. I only pay attention to this if we get above the 70 level or below the 30 level. We're just a little bit under the midpoint right now. But I use this chart if we see an extreme reading. Then another study of the VIX is to take the VIX itself and do a correlation with the S&P. Not really getting all that much right now, a very low reading. We pay more attention to this when we go above the dashed line, and we're not there right now. Then we look at the VIX, and then there's another kind of indicator of the VIX called the VVIX, or volatility of the VIX. So the VIX measures the volatility of stocks. The VVIX measures the volatility of the VIX. I know it's a little crazy there, but some people use this, and then we do a ratio between the two, and this has been going down, and the 50-day moving average is also going down as well, and in this context, that is more positive. Then another sentiment gauge is called the Ulcer Index. It's based on closing prices. I only start showing this chart if we go above the moving average here, which is the red line, and we're below that now. And then we look at the volatility of stocks and then do a ratio with the volatility of bonds. Now, this had been starting to go back up, but now the red line, that's what I follow the most. It's starting to go back down. And as we finally hit the lows in April and been bouncing up, the moving average has been coming down. And so now that this is going down, that is more positive. And we look at a ratio between large caps and small caps. Now, earlier in the week, small caps were looking pretty good. The CPI report came out, and it showed that it came in as expected, and small caps and mid caps kind of took off. Well, then PPI came out on Thursday and kind of rained on that whole parade, and that sent this ratio just kind of gyrating a little bit, but we haven't been seeing all that much. Generally, the way we look at this is in the bigger picture. When this is going up, that means the large caps are outperforming. When this is going down, that means the small caps are outperforming. Well, we've been just kind of chopping along sideways here for most of 2025, so we're not really getting all that additional insight from this chart. This comes and goes out of the daily video as well. In a general sense, this tries to measure risk on. That means folks are getting into stocks versus risk off. They're either getting out of the riskier stocks, the growth stocks that make you money, because they're afraid they're going to go down and they get into more conservative stocks, or they take their money out of the stock market and go over into the bond market, which is considered to be a safer market. Well, as we were coming up out of the April lows, this was going up, but now we've been just kind of chopping around lately, not showing an awful lot of conviction. Another measure here is high beta. This is Apple, Nvidia, Google, the big stocks, Microsoft, and so forth. When we were coming up out of the lows, the high beta to low beta. High beta means that they outperform the market when they're going up. They also go down faster when the market's going down. And then folks would switch over into low beta stocks that don't have as much impact on what the actual market is doing. Well, this was going up, and that was more positive for the market. And then we started coming down right here at the end of July into August. Now we've been chopping around a little bit, and we just kind of not really showing any conviction right now. And this is for informational purposes. These are the different percentage gains from the October 2022 low, the October 2023 low, and the April 7th, 2025 low. Then we want to keep an eye on how far away are we with the S&P 500 from the 200-day simple moving average. If we get above this dashed line, that's 10%. That means the current price of the S&P is 10% above its 200-day moving average. And when we get above that, that's when the market can sometimes become vulnerable. Now, if you've watched my videos for a while, going back to the middle part of July, that's when we saw some weakness develop in 2023 and in 2024. So I put a video out there saying, be aware of this. It may not happen, but be aware of it. It happened the last 2 years. Is it going to happen again this year? So far, it has not happened. The one big difference between what we're seeing in 2025 when we compare it to 2023 and 2024 is we're not above this dashed line. We got above this. Notice in July, we were getting way far away from the 200-day moving average. In 2024, we got above it. That was in the spring of 2024. We had a pullback. Then we really started to shoot up again. And in July of 2024, we were far away and we pulled back after that. This hasn't happened here. So that's kind of changing the scenario a little bit. I don't just look at this chart. There are other charts that we use to try to reach a consensus to figure out, okay, what's the overall picture and what's the story that's being told. And for right now, we're still below this 10% level. Anchored moving averages. Since we've been going up, all of the anchored moving averages that I follow are showing potential areas of support. We had one from this breakout. This is when a trade deal was announced, I believe, between the US and China, and we gapped higher that day. Well, if we start to come down, we'll be watching this as a support level. And since we're far away from that, there's been no need to really show this chart. Then I haven't been showing the advanced decline line more deeper studies lately because they're not really telling us all that much. This is the cumulative advanced decline line for the S&P based on price, just coming off of setting a high. Now, a little bit of a negative divergence here is when we look at the cumulative advanced decline line for the S&P based on volume, when we made it the new high based on price, we did not make a new high based on volume. Not a huge deal, but something we still want to watch. We want volume and price to confirm each other. And when it's even more positive is when we see volume actually outperforming price, because that can also tend to be more positive for the market. But that can also be true when we're going down. If volume's going down faster than price, that can be more negative. And we look at a short-term advanced decline ratio. Now, I show the top part of this chart in a different way. It's a blue line that I show in the daily video. This is just a little bit of a breakout of that, and it's based on price. The additional information that we get from this chart is also volume. We're above zero, even though we fell a little bit on Friday, both based on price and volume, but we're still above zero, so they are considered positive. Then this is a longer range look at the new highs, new lows for the S&P. We were really dropping off. Now we were still above 50, so we're positive, but the context is that we were negative. Now we've been seeing an improvement here as this has been coming back up. There's another advanced decline line, but it measures the NYSE. Not making a new high yet, but still looking pretty solid with the cumulative advanced decline line. Then this is a regular advanced decline line, which is calculated in a different way. It did make a new all-time high, but then pulled back in Friday's session. This is another NYSE advanced decline line, which is calculated in a little bit different way, coming off of a recent all-time high. So this is positive overall. Then we break it out just based on common stock, but we're seeing a negative divergence. We have not made a new all-time high based on price here with the common stock on the NYSE, nor have we made that with volume. So we're seeing it in the bigger picture advanced decline line, but we're not seeing it just on common stock. And common, that's what we own. Those are generally the shares that you buy through your broker. So we would like this to confirm each other, and we're a little bit concerned about this because of this negative divergence. Then another broad market measure across the Amex, NASDAQ, and NYSE, and a 5-period moving average of the highs minus the lows. We were showing some weakness. We were coming back down close to the zero line. Now this is starting to bounce back up. So this internal measurement is actually giving us a little bit more confidence. But we also want to remember that negative divergence that I just talked about. All right, large cap growth just coming off of recent all-time highs. Haven't been showing this because we've been looking pretty good overall lately, and we're above all the moving averages. Then momentum stocks. When the S&P is going up, momentum stocks have a tendency to outperform. If you look here in March, when we were starting to go down and we were really heading down, momentum stocks actually held up better. They were outperforming the S&P. Now we see them beginning to underperform, at least as we get more into the middle part of August. U.S. versus international stocks, improving with U.S. stocks, but they're still underperforming in the bigger picture. Going back to the beginning of 2025, we saw this ratio really coming down, and it's improved a little bit, but it's not like U.S. stocks have really come back in and taken a leadership role. Then stockcharts.com has technical alerts. These are for the whole week, which usually we get a lot more than this. But if they're red, that's negative. If they're green or blue, then they are positive. And we had some positive things. This was happening on Tuesday and Wednesday, and then things started to turn a little bit more negative as we got later into the week. But still, the early part of the day was positive. It was just, you can see the time over here. A lot of these are triggered right after the market opens. And then if we go down after that, it doesn't necessarily trigger a red alert. It just doesn't. You're not really getting picked up the weakness that we're seeing. That's why I also follow an intraday chart. Then I look at 6 different indexes and we rank them on a score of 0 to 100. The higher the score, the better looking that particular index. Coming in first place is the NASDAQ. Not the NASDAQ 100, but the NASDAQ. Now we want this to be up into the high 80s, low 90s for it to be really strong. It's still respectable at 83.7, but we would like to see this really go up. Then in second place are the QQQs, which is the NASDAQ 100. Showing a little bit of weakness here. We're seeing some negative divergences in the NASDAQ 100 that are causing a little bit of concern. We just want to keep an eye on those to see if they develop into price action. But it's coming in second place at 79. Then typical, we see the S&P in third place because that's a mixture of growth and value, where the NASDAQ and NASDAQ 100 are more just growth. And this is still coming in at 71.4, not really, really strong, but still holding up fairly well. Then we have the small caps at 47.9, still below 50. You can see how we were really starting to shoot up here. We actually got into the 60s, and then Thursday and Friday were not kind to the small caps, and the score ended up dropping down. Then we have the Dow, which did set an intraday all-time high, not a closing high, but that was set on Friday, and it is improving, but still below 50 at 46.6. Then in last place are the mid caps. They were also improving. They got up into the 40 range, and then in Thursday and Friday's action, dropped all the way back down to 17.8. Short-term rainbow, this goes from 10 periods up to 50 periods. Price is still above all the rainbow lines, and the rainbow's going up. That's positive in the short term. I'm keeping an eye on the 20-period simple moving average. This comes and goes out of the daily video. If we're getting close to it, I start showing it. But now we're kind of far away from it. Not really, really far, not extreme far. But If we do see a decline from here, I'll put this back into the daily video. But for right now, this just shows that the short-term trend is positive. Intermediate term rainbow, 50 periods up to 100 periods above all the lines, and the lines are going up. Intermediate term trend is positive. And we look at a 50 period moving average, kind of the same thing there. We're far away from it, and that's rather extreme. I have a thing called the boom indicator, which measures the price and then the value of the moving average and then the distance between the two. And I use that like an oscillator. And we are extreme far away from here because if price gets too far away from a moving average, it has a tendency to move back. Well, we've been seeing this reading now for quite some time as the market's been quite positive lately. Now, if we do start to fall, and especially if we fall below the 20 period moving average, then we'll start looking at this chart to see, okay, will there be some support provided at the 50 period moving average? 100 period moving average, same thing. And been looking pretty good as far as the bars here, even though we're starting to flatten out a little bit with the last few trading sessions. But we're above the 100-day moving average and the lines are going up. That's positive. And then another momentum oscillator. I only show this if we get extreme positive or negative. This is called the Connors RSI. It's not giving us an extreme reading right now. These are just percentages. And again, I always like to caution here. I put these lines on here, and if you move them just a teeny tiny little bit, the whole percentage thing will change. So don't use this as anything real substantial. The other chart that I showed, I actually use a spreadsheet to calculate those percentage changes. What we're going to be watching for here is if we stop going up at some point and then we start to go down, we're going to be watching the percentage change of the decline. Because if we're 3, 4, 5%, that's just a normal pullback. If we start to get closer to 10%, that's when we get a little bit more concerned. If we go over a 10% decline, that's when we start to enter into a correction phase. And we did that back in April. And then if we actually go over 20% on a closing basis, that's when we officially enter a bear market. Well, we got really close to that point in April, and then that's when a lot of buying came in, and we didn't spend very much time there, and then we bounced up off of that. We gyrated all over the place for the while as nobody really knew what was going to happen from here. And then finally we were able to break to the upside. So nothing really to see right now on this chart other than these previous percentage measurements. This will come into play if we do start to come down. All right, then the S&P 100 is outperforming the S&P 500. Not really seeing any real divergences here on this chart. Then the mass index daily chart, we're still working off of a signal on the weekly chart, but the longer we get away from that signal, the more irrelevant it becomes. This is not generating a signal right now. We only pay attention to this if it gets up to the red dashed line and the blue line, and it's not there. Standard deviation, I did use this one day because we were really starting to move to the upside and we actually broke above the moving average. Now we've dropped down below it. This is just measuring speed, whether we're going up or down. It's not direction. It's over the last 10 periods, how fast are we moving? And now we've started to slow down a little bit to drop below the moving average. Then the CMB composite, this was in the daily video. I think it was for Friday. Now we saw a drop here, and it's actually dropping below the black line. I only use this when we get above the black line or below the bottom black line. Now it's more in neutral reading as far as I'm concerned. And then same thing with the percent B. When we close outside of the upper Bollinger Band, we spent a couple of days up there. Well, now we've dropped back down. We're inside of the Bollinger Bands now, and so we've dropped down a little bit, not getting an extreme reading here, so I stopped using it in the daily video. And the praying bottom fisher, not giving us a buy signal. When the black line crosses above the red line, that's when a signal is generated. No new X's. Now, we did have some earlier in the week when we were able to push to a new all-time high. This is just after Friday's session here, but this is still looking pretty solid overall. An ascending triple top breakout that was generated back on the 13th. So this chart is, and this takes price into account, not time. So this chart is still looking pretty positive. A long-term rainbow above all the lines are going up. This goes from 50 periods up to 250 periods with the simple moving averages. And I was showing this chart. Kind of surprising. We don't get many signals from this chart. We're crossing back above the red line. Now I pulled it out of the daily video because it may be years before we see another signal from this chart again. We did get one earlier in 2025, but before that, we didn't get a signal since the end of 2023. So this can last a long time. I do show it in this video, and when it is doing something, I put it into the daily video as well. Then we look at a weekly chart of the S&P and a weekly chart of the German DAX. That's the biggest market in the EU. Fairly strong correlated relationship. They're tending to go in the same direction at the same time, either up or down. Then this was something I was using earlier on because we were trying to come up through this little mini rainbow. This is a 20 period simple moving average of the open, high, low, close. And sometimes this will act as support. Sometimes it will act as resistance. We're above all the lines and the lines are going up. We're not really getting any additional insight from this chart, but it is positive since we're above all the lines and the lines are advancing. And Ichimoku cloud, we're still well above the cloud, so I haven't been showing this. The green line here, we saw the downward move in Friday's session. That's more short term. And then the blue line, that's more intermediate term. It's still above the red line. It got close there for a while. And then longer term is the red line. And so this is positive, short, intermediate, and long term. And price is above the cloud, and the cloud is green. So we're not really getting any additional insight from this chart, but it is positive as well. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. And the QQQs, sometimes we pull this out. There's so many people that invest in the triple Qs, which is the ETF for the NASDAQ 100. We're well above the moving averages, and all the moving averages are going up. So this is still looking positive, even though we did decline on Friday. Then this measures the volatility of the NASDAQ 100. It's called the VIXN. We've been declining with the bar chart as well as the line chart. Then we look at the S&P and then a growth to value ratio here in the middle, coming down a little bit, but still seeing a pretty strong correlation. We're going to be watching this. If this continues to drop because value is outperforming growth and the S&P is going down, that's when we would see this correlation actually continue to fall. And that might mean that the market is becoming more defensive. But we did see it on Friday, but are we going to see any follow through in the upcoming week? We look at the Dow, that's in black, and the transports, which are in red. The transports were improving, then they fell back. They're trying to improve again, but they've been underperforming the Dow now for quite some time. And we're a little bit concerned here, regional banks and then to the financial sector. We're still in a downtrend, even though we're not falling apart with this ratio. These are the smaller banks, and they've actually been improving a little bit. But we're a little bit concerned about the financial sector itself. It's really been underperforming the S&P. And if this has been outperforming a little bit, that could end up being positive, but it also could keep this ratio from really turning back and looking more positive. Here's the bank ETF, where we're still above the 50 and 200-day moving averages, and we are in an uptrend. So, but we're not breaking out here. We get up to a certain level and we top out, and then we start to come down from that point. So we're positive, but we're not really showing any real strength with this ETF right now. And we look at another ratio between energy and the 10-year bond yield, not really showing us anything. Been going sideways going back to the beginning of 2023. We look at another ratio between gold and the S&P, and this is going down. Gold's been going sideways, the S&P's been going up. When that happens, this ratio goes down. That means gold is underperforming. And we look at an emerging markets versus developed markets like the US and the EU. And the only thing really kind of keeping this together right now is Europe. They've been outperforming US markets. There are times when US markets are doing better. Those are the developed markets, but we've been pretty much going sideways with this ratio. Then we look at the 10-year yield in the US and subtract the German 10-year yield, and that gives us a result up here. And we compare that to the US dollar index. They'd actually been going in opposite directions there for a while, but we're seeing this correlation start to strengthen again. This is the German DAX. It's still above its 50-day moving average, but the S&P lately has been outperforming. We're not really setting new all-time highs here with the German DAX. And we see that a little bit here. Now, when this ratio is going up, that means U.S. stocks are outperforming. But they have a lot to overcome because in the earlier part of 2025, this ratio was really going down. Then we gyrated all over the place. Now we've seen more of a sustained up move, but we did see a pullback in the latest reading. Want to keep an eye on retail. When we look at retail itself, and that's the middle chart, looking pretty positive. Not at an all-time high, but we're still in an uptrend here with this orange or red line above the green line. That's a 50 period above a 200 period moving average. The RSI is still above 50, even though it declined. Where we're seeing a discrepancy is when we do a ratio between the retail sector and the S&P. It's just going sideways right now. But that's better than what it was doing. It was headed down and actually underperforming. And this comes and goes out of the daily videos kind of as they're needed. The top area, this is a weighted discretionary sector versus a weighted staple sector ratio. And we are seeing a bit of an improvement here. Now, the reason the weighted versions might skew what you're seeing is because Tesla and Amazon make up a huge part of the discretionary sector. So what I do is I use an equal weight version where all of the stocks are given the same weight and how they're calculated. This is also showing some improvement. So we're seeing a little bit of an improvement here, a little bit of a confirmation, breaking out a little bit more with the equal weight version. Now the tech to utilities, this is a growth to value ratio that has been improving lately. Now we were seeing a real improvement with the biotech, which is growth compared to healthcare, but healthcare is seeing some love lately. And even though it's still performing pretty badly on the chart, you've got folks out there that think, okay, maybe we bottomed out. Maybe the market's getting ready to go down. Maybe we're going to get into more defensive stocks, which are what healthcare stocks are. So we're seeing a little bit of a pullback here when compared to biotech, which is a growth area. But overall, this has been going up. And then we look at hotels, which are discretionary, versus utilities, which everybody has to have them, even if that's now considered a growth area. This has been improving, but it did pull back in Friday's session. Then we look at what are called bellwether industries. These are the real backbone of the U.S. economy. Semiconductors are still looking okay, but kind of chopping sideways. Home builders have really been improving. That's when interest rates were going down. And there was even talk of a 50 basis point cut. Well, then PPI came out on Thursday and kind of rained on that parade. And since that time, the home builders have been chopping a little bit sideways. But in the bigger picture, they are improving. The transports were also improving, now going sideways. Retail, I went through that. Now it's going sideways a little bit here. And then the smaller regional banks, they were showing some improvement. And now the last few trading sessions have gone sideways. Rate of change charts long term based on 250 periods. Even though we declined a little bit here, we're still looking at the bigger picture, which is positive. This is also 250 periods, but it goes back to 1980. This is also looking positive in the longer term. Then we try to look at the interaction between bonds at different maturities to see, can we get any insight about what the market is considering as far as what's going to happen with inflation and interest rates. Not really seeing much of a change here when we look at cash to 3 to 7 year bonds. If the market was worried about interest and inflation, this ratio would be going up, and it's still having a tendency to go down, even though it popped up a little bit the last few trading days. Then we use TIPS, which are Treasury inflation protected securities. Folks favor these when they're worried about inflation and interest rates, and we see them outperforming. Well, they were starting to outperform, but now they're pulling back right now when we compare them to 3 to 7 year bonds. So TIPS are what folks get into when the market's more fluid and they're concerned that interest rates are in the process of going up. Once they top out and start to come down, that's when folks jump over into 3 to 7 year bonds. We're not seeing really any concern on this chart, and we're not really seeing any concern here. Same approach, TIPS to 7 to 10 year bonds, pretty much going sideways with this ratio. And we look at the S&P, which is in red on top, and then the long-term bond, which is in blue, and we can see the the long-term correlation is starting to drift off, and they're actually having a tendency to go in opposite directions in the short term, because the S&P for the most part has been going up as bonds have been going down, and that's pretty much what you would expect in a more normal environment. That same approach, except here we have the QQQs compared to the TLT, which is in red, and the Qs are in black. The longer term correlation dropping off a little bit, but still a slight tendency to go in the same direction at the same time. 2-year yield still declining overall, and that's just showing how shorter term interest rates have been coming down. Then an apples to oranges comparison here. Eurozone stocks with US bonds. Eurozone stocks are outperforming. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then I have these things called possible positive scenarios. I really used these heavily back in 2022 when we were really in that downward bear market on a cyclical basis. Well, not really getting any insight here. These are the percent of stocks in the S&P above their 200-day moving average. You can see here, when we get above this green line, that means maybe we're going down a little too far, too fast. We're not there now, nor are we. Actually, we're going up too far, too fast on the top. We're going down too far, too fast on the bottom. The takeaway from this is that we are positive since we're still above 50. And then we do that same logic here, but we look at the 50-period moving average. We're still above 50 with the S&P, and we're declining, but still above 50 with the mid caps, and we are declining, but still above 50 with the small caps. Then this is something that we're going to keep an eye on. Right now, it's looking quite positive, but if this ratio really starts to roll over, that could mean the market is starting to get more defensive, but we're not really seeing that yet. This is what happened at the end of 2021. This ratio rolled over, started to go down. Then we got into 2022. The S&P still set a new all-time high, but this ratio was already falling apart. And then we went down after that. Now, it looked like we were starting to see that happen back in March and into April here, but then we bounced up out of the April lows, and this is switching back to a more of an offensive approach rather than defensive approach. But if this does start to come down, we will keep an eye on that. So thank you. I hope you're having a wonderful weekend. I hope you found this video helpful, and I will talk to you in the next video.